reinvestment of the savings, would definitely be a primary use of the gross savings, so the net. But I guess if I just take a step back and think about how this might change the organic growth outlook for the business overall, I think, investors think that this business is, maybe in like the 4 to 5% organic grower over the cycle. But I'm wondering if this, reinvesting these savings would firmly put the organic growth, something, above that sort of 4 to 5% over the long term, in your view.
Well, let me take that one, David. This is Pat. A couple things. It depends on whether or not this is the first softening or hardening market cycle thing, if you will, that's really looked different. This is a long, hard market we're in. And it goes back to this, I think carriers now, not unlike what we saw, by the way, on the health side, have really understood their loss costs and are beginning to make sure that they're trying to do everything they can to price out in front of that. And that's being done by line. So you see some softening in D&O over the last couple of years. It should soften. It was good for our clients, and carriers were making enough money. If that continues, then that, number one, I think will continue to just our pure unit growth is better today than it's ever been. Secondly, remember, we're competing 90+% of the time with somebody substantially, not a little bit, but substantially smaller than we are. And every day, when Doug talks about investments, if we get a little granular, you look at what we're doing with Gallagher Drive, what we're doing with data and analytics, our one-source capabilities, growing that around the world, being able to give you on a daily basis what happened yesterday with the audits that we saw come through our system and the adds or deletes from our product or from our customer base. It's incredible what we're getting. Now we sit with a bunch of clientele and we start talking about that. The little guys just frankly cannot stand up to that. And so I look at it and go, well, give me some sort of a reasonable market that is going to meet inflation, and I don't see inflation going backwards, and then add to unit cost growth. And yes, I think we'll exceed 4% over the entirety of whatever cycle's out there. I really do.
Got it. Thanks. That's helpful. And then maybe, some of those comments you made, just 90% of the time competing against smaller brokers. You guys are definitely winning in that middle to upper middle market space. I guess I wanted to just ask a little bit about large account, and, just get a sense for how you guys are doing there. And if, how much of your business today is large account? Is that are you guys making a concerted effort to grow in that large account business? And is that just sort of like a new segment that, you guys could just take more share in?
Well, first of all, I'm going to turn it over to Mike, but let's position this. In the Fortune 5000, there's 5,000 accounts. We touch them all. We're talking to them all every day, and we have our share. And that's the 8 to 9% of the time that we do compete with Marsh and Aon, frankly. And guess what? We are really, really good at that, and that's not a new segment. Beatrice Foods is who started Gallagher Bassett with us. We've had the likes of very large Fortune 100 companies, I won't mention names, for 20, 25 years. We're managing captives in Bermuda for these companies. We're doing global approaches. This is not a new segment. Now, I think we're a little bit stronger player in some of that than we used to be. But, yes, it's a focus to grow there. But let Mike talk about some of the stats that we're seeing as we look at our general book of business and growth. Go ahead, Mike, on the size of accounts we're writing.
Yeah, David, you might recall, I think in the June IR day, we talked a little bit about this, and I gave some stats, and I'll share those again. We talked in my prepared remarks, I talked about sort of the average size account and what we typically see in our overall book of business. But if you look at our takeaways, and we measure our takeaways in terms of our new business, 53% of our new business accounts pay us over $100,000 in overall revenue. So that's a business that's paying $1 million plus in premiums. That is not a small account. It may not fit the profile of the Fortune 1000 or the Fortune 5000, but it is a large, complicated risk. And then if you break that down even further, over 35% of those accounts pay us over $250,000 in overall revenue. And so those are extremely sophisticated accounts, $2.5 million to $4 million in premium with very complicated needs. I think what has happened from a strategy perspective is all the investments that we've talked to you about over the past, from Drive to Smart Market to some of the analytics tools that we have started to get the attention of that kind of account and of the risk management community. So we've earned the seat at the table to have a conversation. And remember, risk managers, if you break down that Fortune 1000, many risk managers have multiple brokers serving their needs. And they do it on purpose because they want to have a way to not only play them against each other, but also have advice that's coming from different angles. And so our opportunity now that we have both reinsurance and Gallagher Bassett and all the tools that we feel we need to compete on any one of those accounts, we've earned that right to sit with those risk managers. And I told you in June, we had come off of our meeting at RIMS, and the kind of attention we were getting, the quantity of meetings we were having with many of those Fortune 500, 1,000, 5,000 accounts was significant. And so the strategy is paying off. It requires continual investment in the tools that those kind of accounts need to address their needs. And by the way, when Pat said 90% of the time we compete against someone smaller than us, oftentimes they have that one account or two accounts in that smaller brokerage that are worth $250,000, $300,000 in revenue. Those are really good opportunities for us because we have tools and resources that they don't possess.
I can tell you every single time we buy a $5 million shop, there's 4 accounts that matter. And those 4 accounts are in that range that Mike's talking about. So when we compete 90% of the time with smaller brokers than ourselves, that many of those accounts are coming from them, which also helps us in our acquisition activity.
Got it. That's really helpful. Thanks a lot, guys.
Thanks, David.
Thank you. And our next question is coming from Mark Hughes with Truist Securities. Please proceed with your question.
Yeah, thank you. Good afternoon.
Mark.
I think you've touched on a lot of this healthcare issue, but I'm interested in the way the inflation numbers suggest healthcare inflation is flat to down, even as the benefits expense, the healthcare costs for employers are up substantially. You gave some specific categories, higher physician costs, higher hospitals. How is it that inflation is negative but costs are up?
Yeah, I actually read an article, I think it was in the Wall Street Journal a couple weeks ago. Medical inflation often lags CPI for the reasons I indicated before, because they're under contract with the health plan, the health carriers. Give you an example, I got a stat last week, I believe, that when we get a stop loss renewal, we get it this far in advance. In fact, earlier than now, typically for January 1. These are for the self-funded plans, and they have their stop loss insurance over the top. Out the door from the carrier before we begin negotiation, we're seeing an average about 17% over current year. So that's before we get to work on it and so forth. So this is coming. This is everywhere I read, every carrier is saying the same thing, what we're seeing, and that's what we're expecting.
Right. And that'll impact workers' comp as well, you think?
Well, it's a different mix of what's being provided. Remember, the medical inflation includes a lot of these more severe diseases, disease state, things of that nature, things that came out of COVID complications. When you have workers' comp, I'll let Scott talk about that. It's often a little bit different than that. So, Scott?
Hey, Mark. This is Scott. What we're seeing right now is probably lower levels of inflation. It's obviously, we're tied to whether a fee schedule goes up. And I think as Bill was referring to, sometimes there is a lag there. But right now it's still low single digits. And I guess it's fair to assume, kind of like what Bill's describing, that in time there may be an increase. But at the moment, as it relates to the medical side of the comp claim, it's still low single digits in terms of the actual increase. The indemnity side is seeing a little bit greater pressure.
one more thing to add. I should have said this earlier. One of the fastest cost drivers in medical inflation is on the pharmaceutical side. And so we are getting a lot of new business on our pharmacy consulting practice, really finding a way to dig into where the money is within these PBM contracts. There's certain things you can do, like limiting the formulary, what's available, but there's a lot more to it in terms of the contracting, and that's where our expertise differentiates us from most of our competitors as well. So what Scott's world won't see is that pharmaceutical impact that we're seeing on the medical side.
Yeah, Mark, listen, one thing, just mathematically, you could have, let's say, a 1% pullback year over year, but if your pricing is still hasn't come through the system by 10, 15%, something like that, a 1% change year over year still means you got to put 10 to 15% through it. And I'm not predicting 10 or 15%. I can tell you in our own plan, it's 6.7% is what we're seeing as true underlying inflation as we're going into next year's renewal season, and that's a little bit of a hope on that.
Yeah. Thanks for all that. On the wholesale business, I think you said domestic PC retail, there wasn't as much renewal premium, perhaps because of the mix issue that 2Q is stronger on the property renewals. Similar phenomenon within wholesale, or not so much?
Yeah, I mean, there's key times within the year that different lines of business, and candidly, it shifted over time because it all used to be renewed during wind season, and then it really became less during wind season and more pre and post, just to get out of that problem time. So there's had a little bit of a timing, but it's not, our business is large enough that it's pretty consistent month to month.
Okay, great. Thank you.
Thanks, Mark.
Thank you. And our final question is coming from Charlie Lederer with Citi. Please state your question.
Just wondering on the organic revenue growth bump from ASC 606 accounting in the fourth quarter last year. I believe it had to do with more efficient execution. Is that something you have the ability to improve further and accelerate organic growth recognition again as the centers of excellence continue to get bigger, or am I not thinking about that the right way?
No, you are thinking about it the right way. I think that when you look at we evaluate our assumptions every quarter, and not dissimilar to doing kind of reserve reviews that the carriers do. As we get towards the end of the year and we start looking at our budget process, that's where it naturally comes forth about where are we seeing efficiencies that allow us to the more efficient we serve a customer, the faster we can recognize revenues. So that's what you were seeing last year. I don't want to call it an unlocking because that's more of a DAC terminology, but in this case, the ability to execute and deliver more at the point of policy issuance date, the faster we can recognize revenue. There's not a concerted effort to be working on that in order for the accounting aspect, but it does naturally happen.
Got it. Thanks.
Thank you, Charlie. Well, thank you, everybody, for being with us this afternoon. We really appreciate it. From my vantage point as the CEO, I believe the business is in fantastic shape. I believe we do have the most talented team in the industry. We've got great relationships with our carriers. We've got fantastic client service and retention. I'm really excited about our near-term and long-term prospects. I hope you saw that today or felt that today. And we look forward to speaking with you during our third quarter earnings call at the end of October. Thanks again for spending the time with us this afternoon. We'll talk to you then.
Thank you. This does conclude today's conference call. You may now disconnect your lines at